What is going on, everybody? Hopefully you guys doing well out there. Another stock analysis for you today. Today we're going to take a look at Splunk Incorporated, ticker symbol SPLK. This stock just reported earnings today. We'll jump into a little bit why the stock is selling off. It appears a little bit in the after hours, although it's just giving up about half of the gain it had during the regular session. We'll take a look at some of the guidance that they put forth. Then we'll jump into the numbers. I think you'll find these very interesting. And then we'll jump into just comparing it just very quickly to some of the other competitors, see if we can get a little bit of a feel on the valuation, and then finally we'll jump into the stock chart. This stock actually made a really interesting formation, and I actually posted a video on another stock, and this stock actually really nicely performed it. We're actually up here. This stock gapped up a little bit today, and we're trading here. We'll jump into the stock. There's actually some interesting stuff going on with the technicals. We'll take a look at that. But this is a $34 billion software company. They are transitioning from kind of a licensed revenue as we jump into the financials. So their legacy was kind of this licensed software that they gave out. Well, they're transitioning that to a cloud-based offering. It almost reminds me a little bit of Adobe. So Adobe used to license and kind of sell you the software and then, maybe make a little bit of money on the back end with support. But now Splunk is transitioning almost exactly like Adobe was. Well, they're going away from the license revenue and coming into cloud services. So we'll take a look at the margins and see how that. Now, they did come in a little light on the revenue in the quarter, and their Q3 guide came in a little bit of light. So the street was expecting $639 million in the quarter, and they're guiding between 600 and 630. Now, occasionally companies want to come in underneath it. And then so when they post the 639 or the 640 number in the next quarter, it comes in as a beat and a raise and those types of things. I don't know if that's exactly what's going on here, because we did see that Q2 revenue fell down 5% year over year in the most recent quarter. And then when we jump into the numbers, they're definitely off a little bit. And so, this is a company that didn't have the best quarter, but investors are still holding this stock up. It hasn't really sold off a whole lot in after hours, so it's not that bad. Now, they are projecting 20% year over year growth on their revenues, and really this cloud contribution is really what they're projecting. So they are transitioning into these cloud services, which we see here in the financials. This is 3 months ended here, 2019, 2020. And then we've got 6 months here, 19 over 20 in this cloud services. Again, this is what they're transitioning most of their customers to. It went from 70 all the way up to 120, call it $126 million in revenue. That is really super fast growth. And you see they're transitioning away from this license revenue, since that went from 279 down to 176 in the quarter. Now that again is driven by primarily the growth and customers transitioning over into the cloud services. We see for the 6 month, the same type of growth kind of holds true. We almost doubled our cloud revenue from 132 up to 238 million. And that is offset a little bit by this license revenue going from 482 down to 325. Now, the margins are a little bit different story. Take a look at these margins. They spent 5.5 million to make $176 million. I would take that every single day of the week. Now, the cloud services went from they spent about 59 million, call it 60 million, to make 125. It's basically like that's about a 50% margin, actually a little bit higher than that. Those same margins held true here in the previous period. We spent 35 to kind of double our money up to 70. And those margins hold true for the 6 month time frame as well. So I think you can expect 50% margins, roughly, maybe a little bit higher that from this cloud service business. And if they're growing at 20% year over year, quarter over quarter type thing, then I think things look pretty good for me there. Now, from maintenance and services, we see that ticked up as well. So as this licensing is ticking down, the maintenance and service is still there. And that's actually a pretty profitable business. You see they spent 66 million to make 188. So that's really strong. And that ticked up up from $57 million in the previous period that we spent to make $166. You see in the 6 month, it's holding true as well. Now, from a gross profit perspective, this company is really, really, really strong. I can almost see why this stock has made a really, really monster move here, because these are strong margins. You see here, we spent $359 to make, we earned $359 off of $491 million. They made $491 million total revenues, and the gross profit was $359 million. You know that's a software company when you see those types of margins. For the 6 month, we made $925 million, and we brought in $665 million flowed to the gross profit line. That's absolutely phenomenal. Now, that is not the full story. If this company was a little bit more mature, had their other costs intact, this stock would probably be twice as high it is. But you see here the research and development costs, the sales and marketing, and the G&A. So research and development stayed relatively flat for the quarter. You like to see that in a quarter where you had declining revenues. Sales and marketing ticked up a little bit. That I wouldn't say that's concerning, but it's not the best look when you had declining revenues, but you actually had to pay more for sales and marketing. Not always the best thing. General administrative, relatively flat, and you kind of expect that in this type of quarter. For the 6 month, all those trends hold true. And again, we're seeing total revenues decline just slightly, and that is affecting the gross profit as well. So that is maybe the negative, is that while they're transitioning to this cloud service, the growth from a financial perspective on these total revenues and these gross profit, it might not look as good as it might be, but if they can continue the cloud service growth, this is absolutely phenomenal growth. If you give them credit for keep continuing that type of growth year over year, quarter over quarter, things should start evening out. Now, some of it is likely priced into the stock, so you just want to keep that in mind. Now, from a net income perspective, net loss perspective is here. Again, it's not going to look good when we're spending all this money on this other stuff and we have total revenues declining. So we went from $100 million loss in the previous quarter up to 261. And for the 6 month period, we basically over doubled our net loss. We went from 256 up to 566. That's in millions of dollars over the last 6 months. So this is a company that is losing money. How well capitalized are? That's the question you always want to ask with these software companies while you're waiting for theirs, for this company to transition from license to cloud. You also want to know, well, how much revenue do they have? How much financial backing do they have? Can they survive this type of growth? This company is relatively well capitalized. We see at the beginning of the year here in January 2020, they had about 1.6 billion. We've ticked that up to closer to a little over $2 billion. So for the 6 month, they have a net loss here of 566 million. Again, that's not necessarily all going to be cash. There's probably some stock-based compensation. When you jump into the cash flows, you can get a little bit better look at that. But they've got these accounts receivable here. In terms of total current assets, they've got about $3 billion. That's up by about $200 million from the previous period. That's pretty well capitalized. This company can definitely keep things rolling. They're definitely, obviously, by the price of the stock, they're not in any trouble, but that is something that you do want to keep in mind. Now, from a liability side, they did issue some convertible notes in the period, and so they did do a little bit of fundraising. That's where most of the cash, or probably all the cash, that flowed to the top of the balance sheet. Now, from a cash flows perspective, we're on the cash flow statement now. What they do is they break it out by 3 months and 6 months. You don't always see that with companies, but what you do is you pull down this net income number and then you start adding stuff back in. Typically, companies like this, you've got depreciation, you've got amortization, you've got other amortization. They got a lot of amortization going on this company. And then you've got the big number is usually stock-based compensation. Look at this. So you've got these big figures in stock-based compensation. So you can get a little bit better sense of how this company is burning cash by looking at cash flows, not necessarily at net income or net loss in this case. So for 6 months, we went from 93 up to 124. That's certainly not a positive trend, but it's definitely not as negative as when we looked at the net loss. That was doubling. Well, our cash flows are not quite doubling, although they are growing at a relatively significant rate. For the 3 months ended, that trend holds true as well. We went from 129, call it, to up to 170. But it's not that bad. Again, from a cash flow from financing, they definitely have investors that are interested because They have these proceeds from issuance of convertible notes in the most recent quarter that was over $1.2 billion. And so that gave them a little bit more financial runway as this company, again, is transitioning from kind of licensed revenue to kind of cloud services. And that is the story with this stock. You definitely want to keep an eye on that. Now, from a valuation perspective, it's tough with these companies that don't make money. It's hard to find, direct comparison. When I was on a site looking for direct competitors, actually IBM popped up as one of the #1 companies that is a direct competitor with Splunk. And actually, as an investor, if you're an investor in Splunk, I would take that as a compliment and a good sign, because as we see here, IBM is actually their revenues are decelerating year over year, and in fact by about 3%, whereas Splunk is actually growing again at around that 20% mark. They have some other competitors in the space. I think the way you can compare them is this price to sales. It's at 13, and that compares, not necessarily favorable to IBM or Cisco because they are declining their revenues. But when you compare it to like another fast growing company, this Datadog company is growing at 80% year over year growth. Well, look what investors are willing to pay for their sales, 43 times. So compared to Datadog, 13 times sales for Splunk is certainly not that bad. And if they can keep growing sales, I know they just put out a quarter where they had declining sales. They just put out guidance that missed the mark as well. And so you got to be a little cautious, I think, trusting this management, because they're lowering guidance and their expectation of growth has come up a little bit short here, at least in the most current quarter. And it appears maybe in the next quarter as well. So maybe this 20% growth is a little bit lower, but if they can continue to grow, this price to sales will kind of grow into a number that definitely seems reasonable for this space. Now, jumping over to the stock chart, this stock has made what I would call a cup and handle formation. And so we had this, the high before the March lows, the stock sold off into the $90 range, and then it came all the way back, and then notice it kind of chopped here for a second. So you made a new high. So a cup and handle is typically you make the cup here, and then typically you make a new high. You push it over the previous high, and then you chop sideways for a second. This is kind of like a handle, and then this is a bullish formation. And then what, I don't want to say this often happens, but what technical analysis teaches you is normally what's going to happen is upside. And we see this stock traded from, call it this candle at 181 all the way up to this candle at 217. So it had a really nice run, and actually very quickly. And that's about where the stock is hanging out at this 217. I would actually say this stock is probably likely to channel now. So what you're going to have, I believe, with Splunk, since they've guided pretty reasonably on the next quarter, I would say you're likely going to channel with this stock. Once you made this beautiful cup and handle formation and it broke out, now I think you're going to chop in this range. Although technically you do have this positive momentum with these moving averages. We see the MACD is ticking up. The RSI is a little high, and so those are kind of contradicting themselves a little bit. We did have really nice volume on today as well, but I would expect this stock to kind of channel. We're right in the middle of this range. That is totally expected with this stock. You have kind of an equal number of people that are bullish, equal number of people that are bearish, and that's going to put your stock in a channel. So if you want to acquire Splunk and you are bullish about the prospects of them converting their license revenue into cloud, that's going to grow. Maybe they're sandbagging, this guidance a little bit. Maybe you think that's true as well. Maybe you think they're, one of their largest competitors, IBM, is basically in a graveyard. Well, okay, I think you can safely acquire this stock in this channel. I would like to get it closer to this low end of the channel around 190. Whether or not it comes back to that, I don't know. Again, these moving averages show me that where if this line crosses here, typically that's a pretty bullish sign the stock's ready to go up. So I think your upper end of the range is 220. Obviously, if it pushes higher than that, the stock will be off to the races. If it breaks this 190 mark, boy, you're coming probably all the way down to the 170, 175 mark. So there's kind of your risk reward. I think you're right in the middle of it. If you like this stock for the long term and you want to accumulate some shares, I don't think it's necessarily a bad thing to do at these levels. I would definitely be careful with my allocation. Say you had a $10,000 portfolio. I think you'd be looking to get, 5 shares of a stock like this, because you'd want to have about 10% allocated maybe to a stock like this. And obviously you'd want to be overweight maybe the big outperforming stocks in the market, which are the Apples and the Amazons and maybe even like a Tesla and those types of stocks in these markets. But this is definitely a stock I would definitely put on your watch list. Keep an eye on it at a $35 billion valuation. With this type of growth, it could definitely start pushing this up. Also, with a $35 billion valuation, could become a takeover target as well. That would be a massive acquisition for a lot of companies, but there are some tech companies out there that could definitely finance this type of acquisition. So that's not necessarily the most positive outcome for you as a shareholder, but it could be something on the horizon for a company like this. So there you go. That was Splunk. Hopefully you guys enjoyed it. We'll be back again soon with another video. Thank you everybody for subscribing and for your comments. I really appreciate it. We'll be back again soon. Good luck with your investments.